How do you decide whether to trade a covered call or a diagonal? In terms of the capital required, the diagonal will generally require 10 to 30% of the capital required for a covered call. So the diagonal trade is our favorite on this dimension. The dollar return that we get on the covered call will be higher, often by about $1. But the diagonal will have a higher percentage return because so much less capital was committed to the trade. So we have a draw here. Covered calls win on dollar return, diagonals win on percentage returns. As we see here, we can generally expect covered call returns in the upwards of 20% range and diagonals in the 40+% range. Note that whether you are doing a covered call or a diagonal, your maximum profit is achieved in both cases if the stock is above the strike price at expiration or equal to it. So there is no difference here. That concludes our look at the profit picture. Now let's talk about risk. What stock price could give us a loss? The diagonal always has a higher break-even price than the covered call. When we buy the stock, in our covered call there is no extra premium, as there is when we buy the first option of our diagonal pair, the option we refer to as the long leg, since it is the option that we buy. Secondly, with a stock, we have unlimited time for our position to recover, where we can sell additional calls against our stock. With the diagonal, our time is limited to the time when our long leg expires. Let's talk now about how easy it is to place these trades and to capture profits. It is generally a bit easier to get into a covered call because it entails only one option, and an option that is very close in price to the stock price. For diagonals, the option that we purchase in place of the stock has an expiration that is far out in time and which has a strike well below the stock price. Options that have these characteristics are traded less frequently, and so it can take a bit longer for your trade to be executed. For both types of trades, we recommend that you enter your order as a good till cancel limit order. That means that your order stays with your broker until it is executed or until you cancel it. It is not uncommon to get a better price if you're a little patient and give the trade a few days to fill or execute. And we recommend limit orders that specify the price that you are willing to pay. So we give the nod to covered calls on the ease of entering the trade. Finally, we look at how easily we can take profits. With diagonals, it is frequently possible to exit considerably before the sold option's expiration date, sometimes in as little as half the time that we anticipated, and that raises our annualized return. This is almost never the case with covered calls, where to exit early we have to give up a bit of our maximum profits. So we give the edge to diagonals on profit taking. Now that we have a framework for weighing a covered call versus a diagonal, let's take a look at InvestorsObserver's covered call and diagonal trades for Yum. Let's analyze the differences between these two trades using the framework we just reviewed. First, we see that the investment required for the diagonal is just 10% of what would be required for the covered call, just under $900 instead of $8,500. We see that the dollar profit on the covered call is nearly 3 times as large as for the diagonal at $3+ versus $1.15. But if we were to invest the same dollar amount in the diagonal as you would in the covered call, you would have a profit of $1,150 versus the $300+ from the covered call. And that is why we see the annualized return far higher on the diagonal. Please do note that we are not recommending that you do the same dollar amount in diagonals as you would in the covered call. One approach is to shoot for the same dollar profit on the diagonal as you would in the covered call. In this case, that would mean we might do 3 diagonals for under $2,500 for a $345 target profit, similar to the $309 target profit for the covered call. The stock price that would allow us to gain our maximum profit at expiration is the same $87.50 or above for both the diagonal and the covered call. In terms of risk management, we see that we have more than $3 downside protection on the covered call and just over $2 downside protection on the diagonal. This is the reason that diagonals are sometimes classified as riskier than covered calls. So that completes our comparison of the covered call and the diagonal for Yum. Here are a few closing thoughts. If you like a stock but think it might retrace a bit, you might favor a covered call. If you have a high confidence level that the stock will stay above its strike price through expiration, you might favor the diagonal, where you could do more contracts with its lower capital requirements. You might also favor a diagonal if you wanted to do a trade on a very high-priced stock, like an Amazon or a Google. Finally, because the capital commitment is lower for diagonals, this provides the potential for more diversification in your portfolio.